Hey, what's up, guys? Thank you for joining in. I want to talk about now the role of the federal government, the Federal Reserve, in the stock market. A lot of times we hear that the Fed chairman is going to speak. And when that occurs, all hands are on deck from the stock market perspective, meaning that they're going to pause, they're going to wait, and they're going to gasp at the news. The reason is that they are anticipating what is to come already on the stock market. And when the Federal Reserve speaks, that gives them some sort of indication of what is to come on the stock market. The stocks that you're investing in today, the price of those stocks, are priced based on future expectations of that company, not the current state of that particular company. So the stock market is always looking towards the future and not necessarily the present or the past. Although they do use the present and the past to help them make decisions, their primary focus is where is this company going in the future. So in order to get hindsight, or not hindsight, but enlightenment on the future of the economy, they like to listen in to the Federal Reserve to see where they are and where they stand from a monetary policy perspective. Now, we throw the term around monetary policy, liquidity in the markets. We throw those terms around. I'm going to try and break some of that stuff down for you in this podcast. In my shadow options program, where we do options trading, I told that shadow options trader, hey, we're going to pause. We're not going to get into any contracts right now until we figure out what the Federal Reserve is planning to do. And the reason why I indicated that is because we want to, when we do options contracts, they're more short term, and the price of that stock in the near term is very important on our profitability, right? We're trying to make money off of an options contract. We need to know where that stock price may go in the short term. And based on the decision of the Federal Reserve, it can make or break a particular contract, depending on what direction it goes and things of that nature. When you're doing options, I tell them, we like for the contract price to be based on the merits of the company and not necessarily from a conversation that's being had from the Federal Reserve. So we know they move the markets, and I want to kind of talk about that and why it's so important to the investment community. So thanks, guys, for joining in, and let's kind of jump into this conversation a little bit. Now, I do have a whiteboard, and I want to kind of talk about the role of the Federal Reserve in the stock market and how it impacts us. I'm not sure how well you guys are going to be able to see this, but just kind of visualize this with me for a little bit. Let's say, now everybody's familiar with the game of Monopoly, right? Everybody as a kid played Monopoly. And we know at the beginning of the Monopoly game, so I told you I was gonna break it down so you can understand it. At the beginning of the Monopoly game, each player is given, I think if I remember correctly, about $200, right? Let's say we got 4 players. Okay, I told you we're gonna make this very simple. 4 players are starting to go around this board. Okay, we've got these different land properties, do not go to jail, all this stuff. We're gonna equate this to the Federal Reserve, guys. So I got a little circle, Monopoly board, and put the word Monopoly here. Okay, got 4 players, and they're all getting $200 a piece. All right, now we're gonna call this the economy. Okay, this is the economy. If you were, if you had a bird's eye view on this particular game, you can look in, you got, different properties, different businesses right here, and you got people going around the board, and money's being transacted. That's an economy. Now, the role of the Federal Reserve. Now, before the game kicks off, you identify your players, and you give everybody $200 a piece. Nobody questions, well, hey, why do I get $200 a piece? We say, hey, the bank's going to give everybody $200 a piece, and then every time you go around gold, you get another, $100 or $200. That's going to be your liquidity in your economy. That $200 by 4 players, that means $800. Just an example, guys. $800 is the liquidity in that monopoly game. So if I was the Federal Reserve, I can look at this economy and I say, hey, there's $800 worth of liquidity in that economy. Now, if the game proceeds and the players are paying rent to one another, we know, player, let's call them A, B, C, and D. We know when we sum up the value of the amount of money in that economy amongst those four players, it's going to be $800, okay? Now, player B may actually have 600 of those $800. He could, own a lot of property. If he has 600, that means the other three players have $200 among them. Still a controlled economy with a liquidity of $800. Now, let me give you an example. Now, let's say there's some weird card in this game that says player B, well, all four players, have what they call an export expense, which means, let's say there is a game in China, right? And they are exporting or providing assets or commodities to that particular company or that property. And our players are having to pay the folks over in China in this, in this game that's actually taking money out of this economy. So let's say, $500 unexpectedly went out of the economy in this game. That means we're stuck with about $300 amongst the four of us because there's a supply shock to the liquidity of the game, okay? Now, in that case, the bank, or let's call them now the Federal Reserve, will have to actually go out there and stimulate the economy again. How do they do that? Well, when you go around go, as opposed to giving the players $100, they say, well, we're going to give you guys $300 to go around go now, because the liquidity in the game has gone down in value. You only have $300 to play with now, so we're going to increase the liquidity of the game itself. That's kind of the role of the Federal Reserve, guys. They kind of monitor how much money is in the economy. They monitor all of the activities that are going along in that particular game, and they're trying to ensure that the money supply is at an optimal level, right? When I say optimal level, that means not too much, not too little, just enough to keep the economy healthy. All right, so that's a little game or a little analogy I wanted to use, guys. Of course, the Federal Reserve is a little bit different than that, but just kind of give you an idea of the role that the Federal Reserve plays as far as monetary supply is concerned. Now, the next question becomes, well, why does this impact the stock market? Why does this impact the stock market? Well, if you go back to my Monopoly game, if the money supply is very little, right? Let's say those properties are now businesses. Those businesses, regardless of how good the product is, they're going to only be able to sell so much stuff because there's no money in the economy anymore. So the great companies, regardless of how great the product is, and it could be like an Apple, it could be a Walmart, Starbucks, and regardless of how great the companies are, there's only so much money in the economy now based on a constricted money supply. That means that in the future, the earnings of those companies or the money they make is going to be limited. That's what the stock market is on the lookout for all the time. How much liquidity do we have in this market? Right? How much liquidity do we have in the market? If the liquidity is constricted, profits or business is going to be a little lower. Therefore, stock prices will move down. Okay, so that's kind of in a nutshell how the stock market, anticipates what the Federal Reserve is planning to do, and they kind of base the pricing of these stocks based off of that. So the stock market is forward thinking. It's a forward thinking entity. Not what you did for me lately is what you're going to do for me in the future. Is kind of what they're all about. So liquidity in the market and and things of that nature impacts the stock prices. Now, tools of the Federal Reserve. Now I talked about the money supply, handing money over in that monopoly game. Well, they don't really, they don't hand money over. The way they constrict or increase money supply is through what their tool. Their main tool is interest rates. Okay, interest rates. That's their main tool. When they increase interest rates, that means it costs more money to borrow. Right? It costs more money to borrow. If you guys are looking for a house to buy, if it's at 8%, that means you're paying a lot more in interest than your principal. That means the interest payments are going to go back to the bank, and the bank borrows money from the Federal Reserve, going to go back to the Federal Reserve, which means they're taking money out of the money supply because they're charging more money to borrow money. And when that happens, that constricts the economy. Fewer houses are going to be sold, fewer cars are going to be sold, and that is going to impact the profitability of the real estate industry, the automobile industry, and it trickles down from that point. So that's how they're able to constrict the money supply mainly. It's through, I don't get into commercial paper and all that kind of stuff, but just from an interest rate perspective, that's how they are able to impact the amount of money that's in the economy. Okay? That's how they're able to impact the amount of money in the economy. And with lower interest rates, for a long time, guys, the interest rates were like zero. They were like, hey, we need to put money out there in the economy, put money in the economy. People had more money. You can buy more house, you can, buy more cars because it was cheaper. And when you're able to do that and the money stays in the economy, there's more money to be made at different levels of the economy, right? So for example, if I had let's say I had a 4% interest rate, 5% interest rate, got knocked down to 3%, right? As a homeowner, that's 2% extra that I save per month. Basically, let's say you're saving now $600 a month on interest payments. Now, I may take that $600, I may paint the house. When I paint the house, I got to hire a painter. That painter now has new work that he didn't have before. Now that painter has money in his pocket. He goes home, he said he's going to take a trip that he hadn't taken this year. All right, now he's going to hotels and he's going to resorts. So that money from that interest rate being me saving on an interest rate, goes into the economy. It went from my pocket to the paint to the painter. So when I bought the paint, I went to Home Depot and got it, increased their bottom line, hired a painter. The painter made more money. So the painter's got more money in his account. Now he's going on vacation. And then that painter is, going to a resort, right? Hire a new worker in the resort because they got to handle all the new folks coming in. Now that new worker has money to spend. So that's how money flows through the economy based on an interest rate change, right? And vice versa, interest rate goes up as fewer, projects around the house, fewer people being hired, to do those projects, fewer people going to the resorts, fewer people being hired at those resorts, you've slowed the economy down. So with interest rates, you're able to impact the economy, both, restrictive policies as well as policies where you're free and you're wanting to get money flowing in the economy and you're wanting it to thrive. So you may ask yourself now, well, federal government or the Fed, why would you not want everybody to have money? What's wrong with everybody having money? Well, if you're living around these times, you can see why. And I'm gonna tell you this right here. Let's go back to my example. I hired that painter. That painter all of a sudden has more money to go on vacation. Multiply everything I'm talking about by 100,000 people or 1 million people or 10 million people. Now, when that painter goes to book a hotel room, those hotel owners are saying, hey, we were running these specials at $249 a night, but I have so many people trying to get a hotel room, we're going to move our price up to $500 a night because the volume is just that extreme. That's called the big word, inflation. Got to control inflation, guys. We've got to control inflation. That's the number one. That's the number one enemy of an economy is inflation. I'm gonna talk to you guys about why that's the case in just a minute. Inflation. Great. Everybody want to have a good time. Everybody have money in their pocket. But what happens is you create a demand that the producers can't keep up with. When they can't keep up with the demand, they got to raise prices on what they have already to slow you up from coming down there. They say, hey, we can make these prices so high. Now we don't have, 500 people trying to get a 300-bed hotel. We can get that down to 250 people trying to get it because other 250 can't, or other people can't afford it. Maybe we can satisfy our customers. But when you do that, you create an economy where, this is a deal, guys, where people who are at the, I hate to use the word bottom of the economy, but people who are at the lower threshold of an economy, if they can no longer afford, and I'll take my example of a hotel and resort, apply that across the whole entire spectrum of the economy. When they can no longer afford to get groceries for the week, put gas in a car, or buy a car, or go on any kind of trip, when they can no longer afford it, and they work 40 hours a week or 60 hours a week and still can't afford it, you got a broken system. And when you have a broken system like that, think about all your service jobs, them just saying, hey man, it's not worth me working. I can't afford anything anyways. You're gonna have a undue pressure. You're gonna have undue pressure on the federal government with programs, subsidies, and you're gonna have these corporations that can't function anymore because if they can't hire people to come and make that bed up, when you leave that resort, bring your soap and towels at the resort, or if it becomes so difficult that they can't make ends meet, period, by milk, bread, and all this basic stuff, you've got a whole area of the economy that is severely impacted by those high prices. Think about the average class person, right? The middle class people. When I say middle class, the people who can go to work, got a decent job, they can send their kids to school, they got aftercare, they pay their car notes, they can go on a trip, they can go out on the weekends. That's kind of be like middle class. When the Federal Reserve goes in and they impact the economy with interest rates, they're not thinking about, or their primary focus is not on the middle class people. Their primary focus is on that bottom tier, ensuring that they can make a decent living for themselves. If you go through and look at some of these studies, you can Google it, they're going to tell you their main focus is the lower tier of the economy. They have to be able to function out here. They have to have be able to pay rent, mortgage, buy groceries, and go to work, put gas in the car, right? So those are basic functions of an economy that everybody is, everybody has the right to be able to do that. That's going to be their primary focus when they start finagling interest rates. When it becomes unattainable for them to do basic things like go to the grocery store, put gas in the car, they got serious problems. And that's why they handle inflation very seriously, because you got a bulk of people that can't, and again, it's not just because they love those people. It's because these corporations are not going to function properly if they don't have the service level employees. They're able to function in those brands. Think about a Hilton. Think about some of these resorts. Look at the MGM Grand, all these casinos. No casino workers, nobody at the front desk of these hotels because they can't afford it. That's going to be a potential problem for the entire economy. Okay. Now, you might ask yourself, well, why don't they just pay all of these people double their salaries, triple their salaries, ensure they can afford it? Well, that's called that's called wage pressure. They fight against that as well, because if you got wage pressure, you're going to kind of devalue the dollar, in the sense that if everybody made $100,000 a year, and just because they have to keep up with the economy, look at the pricing power of the dollar now. Because if those service level workers, let's say they're making $100,000, they're still going to only be able to buy what they were able to buy at $30,000 because the price is going to go up exponentially anyways with inflation out of control, right? That's why they have to control inflation, because if you would tend to devalue the dollar, you start paying everybody all the money that you think they should make just to keep up with the price of with the cost of inflation. So they can't just raise salaries up continuously to match inflation. That's not the goal either. The goal is price control, salary control, steady economy. That's what they're looking for. If you look at the stock market now, bad news is good news, which is weird. If they see the economy slowing, stock market is going to go up. They say, oh, we're controlling inflation now. They see the economy overheating is the word they like to use. That's bad news for the stock market, because that means the Federal Reserve is actually going to raise rates again. They will raise interest. Remember this, guys, when they raise rates, think about that monopoly game I put up. They're pulling money out of the economy, slowing it up. There's going to be less dollars floating around here for people to go out and do different things. So that's kind of interesting. So if I talk about the stock market, I can, I've kind of explained it, but I'm gonna go back through this again. I got a company. Let me create a coffee. Brown's Coffee, right? Brown's Coffee. If I create a company, this is publicly traded, and if I project it, the next 3 months to make $1 million, that's me, a financial report, and let's say my stock is trading at $20 a share on the market. I'm gonna make $1 million in the next 3 months. My quarterly, earnings. Just the lump sum of $1 million revenue. Okay, and my stock price is currently $20 a share. So I'm projecting out $1 million in revenue, and my stock price is at $20 a share. Now, inflation's overheating, out of control. The Federal Reserve goes out there and it raises interest rates again. Remember, the stock market thinks forward. They think, outward. So if I'm trading at $20 a share, I'm called Brown's Coffee. I'm going to say stock symbol BC. And if I'm at $20 a share, let's say this date, so 3 months out, let's give this just arbitrary date of December. This is when I report my earnings. And let's say this is September, the 9th month of the year. And I project out $1 million, and all that good stuff. But the Federal Reserve meets that day in September. Well, the Federal Reserve, let's say they go out there and they look at the economy. I'm telling you what they do. They're going to go out and look at money supply, how much savings people have, spending habits, what are they buying? All those metrics are being watched by the Federal Reserve. It's so interesting how they see everything that the consumer is doing. Consumer confidence. Are you willing to go out and buy that new car? What are your thoughts about moving? They look at all of those things. They got, consumer price. They got all kinds of metrics that they watch. Okay. So when they go out and make a speech, the stock market is, just think about my company's trading here. The stock market, you got guys on the market sitting there watching and listening to the Federal Reserve, because they want to know what they know and what they're seeing, how they're interpreting the information that they're processing. So the federal government comes out and makes a speech, and they say, hey, the economy is overheating. People have excess money in the bank. Credit card debt is, they study debt. They know how much debt everybody's in. The credit card debt is as low as it's ever been. They got a lot of money in the bank. And inflation is already sky high. What are they going to do? They're going to raise interest rates. Now, when they raise interest rates, the people on Wall Street are saying, hey, they're going to pull money out of the monopoly game. So regardless of how high consumer confidence is and how much money people have in the bank, we know from an investing community, the Wall Street folks, they say, hey, they're going to pull money out of this economy. And, the people don't feel it now. These are the people who are not watching any of this stuff. But the people on Wall Street say, hey, they're gonna start pulling money out, which means they're gonna slow down the consumer habits. They're going to take the money out of the bank. It's going to cost you more to do everything. So that means your savings is going to go down. Credit card debt's going to go up, right? Because they know your salary. They know what people have in the bank. They know your spending habits. So they're thinking ahead. So now with Brown's Coffee, say, hey, I'm going to make $1 million in the next 3 months. They say, well, Ray, or Mr. Brown, you're not going to make $1 million. We think you're probably going to make half of that because the economy is about to, slow down tremendously. So the next day on the market, you see my stock was at $20 a share. That thing went down to $15 a share, and we're starting to trend downwards because, again, the stock market is moving. They're thinking ahead based on this information they got from the Fed. So that's how the Federal Reserve impacts the stock market. Okay, that's how they impact, and what they say is so important. Now, let's go back and say this. I talked about this at the very beginning. Let's say I was doing an options contract on this stock, on Brown's Coffee. Well, if I look at the metrics, look at how well they've done, look at the way their management teams run, they're executing the plans. Those are the analysis tools we use to interpret what direction the stock is going to go in. I made a great analysis. I'm like, hey man, Brown's Coffee is supposed to go up higher. But because of an external force, and I have a mentorship program, I call it situational awareness. A situation in front of, that's the first thing we consider situational awareness. The situation around Brown's Coffee is, long term, you may be great, but in the short term, with the Federal Reserve doing what they're doing with the interest rates, it's going to impact the entire gamut, the entire monopoly board. So Brown's Coffee, you're in there in that monopoly board as well. So regardless of how well you're doing as a company, you probably would go up under normal circumstances, but we're about to pull money out the entire economy. Everybody's going to slow down. So that stock price, where normally it would go up, it's going to go down. Not based on the merits of Brown's Coffee, but based on what the Federal Reserve is doing. So that's how the Federal Reserve can impact, even options contracts or, the short-term pricing of a very good company, right? Based on what they're doing. It has nothing to do with that individual company, it has everything to do with the whole entire economy, whole entire monopoly board. So that's how they impact us. But that's bringing the stock price down. We can flip it the other way and say, I'm projecting $1 million. Let's say the economy go through another pandemic of some sorts, and everything slows down. The Federal Reserve decides to lower interest rates, putting more money in the economy. It can go opposite. This stock could go up, not based on what they're doing, but because there's so much money out there that, if they start lowering interest rates, then all companies are going to do better. That's why you see the opposite when they lower interest rates. So the role of the Federal Reserve is critical in short-term stock price movement. Okay, so you're writing down notes. I want you to write that note down to say the Federal Reserve is critical when it comes to price movement in the short term. Okay. That's important. So if you're a day trader, if you're a swing trader, if you're doing options, yes, that Federal Reserve decision in either direction can definitely impact what you're doing. So that's something that you definitely want to be mindful of. But anyway, hopefully I've brought some clarity into what we're doing, either with options or investing in stocks and its role with the Federal Reserve. I think it's critical. It's all hand in hand. The Federal Reserve has a responsibility to keep the economy healthy, to keep inflation down. So they're doing their job. Think about that monopoly game at the very beginning. Everybody just collects $200. That entity does its job, gets the economy moving and keeps it moving in the right direction. So it's very important. They look at, I talked about in that monopoly game, export, import. They look at, money going out of the economy. When we're buying things overseas, our money, goes out of the economy. But we have imports as well, where when we are when we are exporting goods to other economies, we got money coming here. When we're importing, we have money going out, right? So they look at all of that as well. So it's just it's a complicated, simplistic but complicated method that they have to, or process, a method of process that they go through when they look at where we are. And that's why the stock market is very aware of the thoughts of the Federal Reserve. They look for signs and signals to see where are we going next, and it's very important. It all works together. So that being said, hopefully you guys got a lot out of this. This is a great topic. It's very important, and it definitely impacts us when we're investing and doing options contracts and things like that. So anyway, hopefully you guys learned a lot, and stay tuned for the next podcast. Thank you.